Good evening, and thank you for making the time for tonight. I'll do my best to make it worth your time. One of the things, as she mentioned, that we're going to use the chat box or the question box. I've got that in front of me. I'll try and pay attention as questions come up. Certainly, as we go through it, you're welcome to post questions or add more to the content. What I recommend is just sit back and listen. Don't worry about taking notes. After this session, my email address is here on the screen. You can send me an email. I'll turn all the slides into a PDF file, then I'll put those together with some additional reading material and get that sent out to anyone that asks. And I don't do anything with anyone's email addresses. So my phone number and email are both there. I don't charge for phone calls and emails. So if you do have questions more specific to your practice, happy to help on that. So as she mentioned, my name obviously David McCormick. I'm a veterinary practice appraiser, and I do work with Simmons. I have Simmons Mid-Atlantic and Simmons Great Lakes. I cover 9 states. And the content here and what we're going to cover tonight as we go through this is really focusing on the practice's financial health. So is your practice healthy? If not, why not? And my goal is to teach you how to diagnose whether or not you're profitable, what profit means. And then if you're not profitable, what to look for, what symptoms to pay attention to so that you can then fix your practice, you can heal it. So we're going to cover these over the next 2 hours. And the last section is giving you some of my favorite KPIs or key performance indicators, practice statistics, and the ones that when we're doing practice valuations that we look at when we're diving into a practice, assessing the financial health, and then coming up with treatment plans. So sit back and we'll go through this. I want to start with this. The practice's goals, and we visit every practice we value, and I'm in about 120 practices a year, and I often see in the reception areas the mission statement or goals, and almost everyone has the first 2 on this list. And I can poke fun at this because I see it a lot, but it's something along the lines of, we love pets and we're going to take care of your pet just like family, which is great and admirable. However, I think you owe it to your clients. Your mission statement is your promise to your clients. You owe it to your clients, and your team owes it to say part of our mission is to build a confident and competent team, and that we're going to run a financially healthy business so that we can be here for your children's pets. In absence of that, yeah, it's great to focus on the medicine and the quality care and the pet health and everything else, but it's short-sighted not to promise to your clients your commitment to having a confident and competent team and a financially healthy business. Now, part of everything we're talking about tonight is the business side, the money, right? I'm not losing sight of, even though I'm immersed in this, I am trusting that you are focused on providing good medicine. Whatever that standard of care is, that you are doing that as well. You need to have the good medicine with the good business if you're going to do it for very long. In absence of one, if both aren't there, everything tips over and falls apart. So I'm assuming as we dive into the numbers that you're doing this side, the medicine side, strong. So first thing I want to cover, and some of this content is basic because we've got new practice managers here this evening, which is awesome that they're hearing this. I want to bring everyone up to a similar level. So to start this, and those that have seen me speak before, you know this chart that we're coming to, the business cycle, is one of my favorites because there's so much included in this. So I want to start by looking at, well, let's start a practice, right? Ground up. So when you first start a practice, you need capital. You need money, and that comes from one of two sources. It's either money you have, which is your equity, or money you borrow. With all of that money, then, you invest that into buying the furniture, fixtures, and equipment. You stock the shelves with inventory. You put some money in the drawer, boom, you're ready to go. You open up the door, let that public in, and practice medicine. In practicing medicine, you have expenses. You've got the direct expense, drugs, medical supplies, lab, etc., and then the indirect expenses, payroll. We're including you in that payroll. So owners gets doctor compensation or practice management compensation. We have all of our expenses, and then what's left is the earnings or profit. There are three things and only three things that the owner can do with that money. You pay down debt, you can reinvest, or you take that out personally. That's what you do with profit. Those are the three choices. From a long-term perspective, the reason that this matters is certainly, yes, the earnings. If you've heard my sessions on value, and there we can send you a YouTube link if you want to check that out. But more importantly, for the profit is that that's the reinvestment. You want to upgrade your lab suite. You want to convert that food storage room to a dental suite. Anytime you want to give raises, that requires profit. If there's no profit, then it has to come out of the owner's pocket personally. So the importance of all of this is the profit, definitely for reinvestment. When we had the last recession, practices that were financially healthy, or even COVID during the hardest months, if they were financially healthy, they had a cushion on that bottom line, so they could ride that out without having to borrow the money. So in the long-term success, when the practice first starts, the profit is low. And that represents a return on having made the investment in the furniture, fixtures, equipment, and inventory. As the cycle continues, though, the profit, we hope, continues to grow. It grows beyond what we can say is furniture, fixtures, and equipment and inventory. It's just too much of a return on that. It must be a return on something else. So if it's a return on something else, what's that return on? We know this is the evidence of goodwill. This is where the practice goodwill, like the wind, right? We can't see the wind, but we see the impact of the wind. We can't see goodwill. Goodwill, the intangible asset, that's your name, your reputation, also called blue sky. Every practice has goodwill. However, not every practice's goodwill has dollar value. It only has dollar value if it generates a return then over and above the return on the tangibles. So that's pretty important when we look at the practice profitability, and that's what drives the value, which is outside the scope of this session. I also like this chart because here's your two main financial statements. We've got your profit and loss statement, which covers a period of time, most frequently January to December, your revenues, the expenses that you can write off, and then the profit or earnings at the bottom line. And then we also have your balance sheet. The balance sheet, for most practices, they don't use it a lot, except when you have multiple owners, because now we're looking at the value of the entity. A balance sheet covers a point in time. As of this date, these are our assets, these are our liabilities, and our equity. And the balance is that assets equals liability plus equity. Or if you turn things around, basic algebra, equity equals assets minus liabilities. You can think of equity as net worth. The sum of what your entity owns less what it owes is the net worth. Same with you personally. You should be doing both of these statements personally. The left-hand side, the P&L, that's your tax return personally. Your net worth, assets minus liabilities, sum of what you own less what you owe, most people do annually because they kind of track that. So Coming now to focus on the expenses. The expenses come in two main flavors. We've got the variable expense, direct expenses, and then the fixed expenses. The variable expenses are, the term variable comes from the fact that the expense, the dollar amount, varies with the revenues. As revenues go up, the expense goes up. As a percent of revenue, it should stay stable. Whereas fixed expenses, as revenues go up, they stay the same. So think, your electricity is not going to change. Your rent doesn't change, maybe a nominal amount. So when it comes to the veterinary practice, and this is an important foundational element to the veterinary practice's financial health and understanding of your variable expenses, drugs, medical supplies, lab, flea, tick, heartworm, cremation. These are your variable expenses. All your other expenses are fixed. So, and it goes on. Now there's a group that are semi-variable, and that would be things like support staff. It's fixed until you give a raise or you add another doctor to the team, add another technician to the team. If your doctors are on production-based compensation, then they're pretty much variable as well, as long as their production is increasing. Once their production plateaus, then it becomes more of a fixed expense. The significance of this is that the veterinary profession is a fixed cost business. The majority of your expenses, and I'm going to quantify that here in a minute, the majority of your expenses are fixed. What this means, there's a couple consequences to this, and the flip side of a consequence, an advantage, because it's fixed cost business, the more you can do with the same bundle of assets, the same facility, the same team, the more profitable you're likely to be. And leveraging your team is critical. Doctors lean on the techs. If they're licensed techs, the licensed techs lean on their tech assistants, and the tech assistants lean on the general office assistants. Because we want doctors doing as much doctoring as possible and delegating as much as they can. By going through this, you're generating more. One of the examples I use is, think about your practice. If you added one more dental procedure during that day, what expenses would change? Well, you have drugs, anesthesia, doctor, if you're paying on production. That's it. The rest of the revenues generated from that procedure drop to the bottom line because all the other clients from that day paid the share of electricity, insurances, the rest of the team, etc. So that last client, that case that comes up when you're locking the door, is your most profitable client. The owner does not send them to the ER down the street. You get them in there. One more dental procedure a week can make a huge difference because it's a fixed cost business. That's the advantage. Just how can we work more efficiently? The flip side, a discount is deadly because that only changes your top line and the bottom line. Nothing in between changed. None of your expenses went away when you gave a 10, 20, 40% discount because we're a fixed cost business. We'll never make up that profit that you give away by volume. The math just does not work when you're looking at that. So, keeping moving here. The financial management, a lot of people do the financial part. You file your tax returns, you have a bookkeeping, and maybe look at a profit and loss statement. Very few, though, in my experience, actually do the management part, financial management, doing something with the data that you have. Most just do it, they don't look at it and use it. My goal tonight is to help you use the information that you're gathering. So let's look at this. Financial health. What does that mean? When I say financially healthy, I mean profitable. And I'm going to define that in here in a moment because it's not what's on your tax return. Yes, the greater the value, or greater the profits, the greater the value. Those two go hand in hand. The profits, as I mentioned, though, is not what's on your profit and loss statement, income and expense statement, tax return, etc. That's done for tax purposes, and it's not real from an operational standpoint. When I say profits, I mean normal revenues less regular operating expenses, fair compensation to the owner for his or her work as a doctor, and a normal rent if you own the real estate. That's the profit. As if you own the business, but you don't work there, you don't own the real estate, and your books are clean. You're not paying for your cell phones, your car. I was on Dad's payroll when I was 8 years old. I didn't do anything. It was tax strategy. So we're looking at profit as true return on the business. The problem, as I gave those examples, is the data you have isn't real. It is real for you, but it's not real from the perspective of true profit. Because of that, we need to adjust the financial statements. And this is the first step when we do evaluation. We start with the tax returns because essentially there are consequences to lying with the government. But then we make adjustments, and we can make those adjustments for two main reasons. First, non-operating expenses or operating expenses that are missing. So you're the boss, you own the business, you can pay yourself whatever you want. High rent, low rent, no rent, high owner compensation, no owner compensation, depending on tax strategies and your entities. You've got control. I have, we just valued a practice, and the owner said, oh, my two kids are on payroll. I said, oh, that's neat. Are they in high school or college? Oh, no, they're married. They live several states away. They each had $60,000 and $70,000 salaries through the practice. Non-operational. If someone else owned the business, they're not going to pay for that. So we can make those adjustments and remove that. Owner perks, like your cell phone plan, your car. Most of that, is it legal? No, but a lot of people like to do it. So we see that. I had one practice that the owner's daughter's college education was included as continuing education in the practice. The practice paid for it, $30,000 to $40,000 a year. So we make those adjustments. The fewer adjustments we make, the better. So it's a tax strategy, but it's not necessarily a good one when it comes time to selling and exiting from ownership. We also, though, sometimes have to put in expenses that are not there. If the owner's partner or spouse does the books but doesn't get paid, we need to put a bookkeeper in there. Or they're the practice manager, but they don't take a salary. So that can be non-operating, removing non-operating and putting in operating expenses. The second reason for making an adjustment are non-reoccurring, one-time expenses. You repaved the parking lot, new cabinets in the lab. You bought some new equipment, and instead of putting it on the depreciation schedule, you put it into drugs and medical supplies to write it off all at once. Those are one-time events. You're not going to do that every year. So we can remove that. You're really taking profit and putting it reinvested. We cannot make adjustments for bartering, trading services. Now, when we were growing up, I was the oldest of three boys, and Dad had a family gym membership, didn't really pay for it because the owner had 4 labs. So they swapped, right? Just being neighborly and supporting the community. We can't undo that. We also cannot put back unreported cash. So not that you're doing this, because it is a no-no, but if you know somebody that is just kind of taking cash from themselves, you need to get them to stop it, because we can't make that adjustment in value and assessing the profitability. And it's also a terrible example for the team, because if it's okay for the owner to take some of that out, what are the employees taking out? Well, she did it, he did it. I'm going to take this bag of food home. And we're going to talk about embezzlement a little later. But here's an example. I want to share 2 rounds of making adjustments with different practices. I know that numbers will get small, especially if you're looking at this on a mobile device, your personal distraction device, phone or iPad or something. Don't worry, I'll draw attention to the key components. So this practice, small animal practice, grossing $646,000. This is the original financial data. So it's the tax return. We don't have any compensation of the owner because it's a Schedule C sole proprietor. We have then the support staff, all non-veterinary, and then payroll expenses. As we walk through the bottom half, we have facility costs, office expenses. They were fully depreciated, so they didn't have any of that or interest or debt. On the tax return, this practice is being told, the owner's being told they're 18.4% profitable. But that's not real, right? We have to make adjustments. So we go back to the top. This is the operational column. Anytime we made a change, it appears in the adjust column. A number in parentheses is an accounting protocol for a negative number, meaning we reduce the expense. The first expense we put in was to pay the owner as a doctor. We looked at the owner's production and said, what would a doctor on production need to get paid in order to generate that revenue? Whether it goes to the owner or another doctor, it doesn't matter. It's an expense to the business. And in this case, $100,000 based on the production was appropriate. We then, under support staff, we removed the owner's ex-wife. She was getting paid just as marital dissolution strategy, I guess. The tax return had dog training fees. And that sounds good. It's a veterinary practice, right? No. That was the owner's and owner's ex-wife show dogs. So they paid for the handlers and the competitions through the practice. So we removed that. Because we changed payroll, we have to change payroll taxes. CE and travel, we reduced that to a normal level because that had dog show travel in it. And that's non-operational. If somebody else owned this business, they're not going to be having those expenses. On the bottom half, we removed the vehicle expense as non-operational. We left a nominal amount in, $1,000, just for paying mileage for CE or staff running errors. In reality, this practice is only 8.3% profitable. That's a big difference in what the owner was being told on the tax return. That creates the confusion. Here's a different practice. This one's grossing 1.4 million, still a small animal practice. We do have doctor compensation. The owner paid herself $68,000, $69,000. But owner only worked 2.5 days a week. So it was overpaying herself. We adjusted it to a production basis in line with how the associates were paid. So we could fix that. We removed the family vacations, that non-operating expense. And then down below, on the second half of it, we had to put in a fair market rent. The owner owned the real estate, charged herself $24,000 a year, but based on the real estate value, a fair market rent should have been around $78,000 a year. We removed the owner's personal life coach, buried in professional fees, and removed the vehicle. Depreciation and interest expense we remove as well. Interest expense, when we assess profitability, we're looking as if debt-free. If there's no debt, there's no interest, so we can remove that. We remove depreciation because it's not real money spent. That's based on past purchases. You have to write those off over time. So depreciation in any 1 year is the sum of what those write-offs from the past. So in reality, this practice is 6.4% profitable. Now I'll just jump, and that's not good. So here's the typical reference of what we're looking for. The average practice, if you think about the bell-shaped curve, right? Ooh, nice bell-shaped curve. That hump in the middle is 10 to 12% profitable. That's the average practice. We consider a practice to be financially healthy if it's 14 to 18%. So we're coming down that right-hand slope. Well, I guess you're looking at me, that right-hand slope, 14 to 18%. That's the financially healthy practices. Half of all practices, though, are 10, 12% profitable or less. That's not good. And 9% or less is what we refer to as a no-low practice. So no or low profitability and no or low value. And size does not, gross revenues does not have anything, unfortunately, to do with this. I valued a $13 million grossing practice that was 0.6% profitable. 0.6. They were not making a penny on the dollar. So that's a problem. And no low practices. I want to take a little sidestep into no low practices, because this came out about 15 years ago, 12 years ago on the Valuation Council. You know, Dad and I are valuing these great practices, nice revenues, beautiful facilities, and no profit. We started talking with our colleagues on the council, and they were seeing this as well. And what we realized is there's this illusion that's happening for practice owners. So coming back to where that chart, right? There's three things the owner can do: use the profit. You pay down debt, you reinvest, or you take it out personally. Through the life cycle of a practice, those three shift. And once the debt's paid off, practice is cruising, you're making some money. And then you borrow some more money because it's time to reinvest and grow the practice. And so you're taking out less. And then, you know, after 10, 15, 20 years, okay, the kids are out of college. The practice doesn't have any debt. There's nothing left to reinvest. So the owner's taking a lot home. Hey, honey, let's get traveling. We've got some cash. And so it appears like there's a lot of cash. And at the same time, every year, your revenues are going up, your taxes are going up. And so you're getting all this subconscious feedback saying your practice must be doing great. But that's an illusion, because we've got in that owner take home, we've got your doctor compensation. You got the facility rent mixed in there. And so they're getting this feedback that it looks good, but in reality, it's not. And part of this and the illusion is that you have no sense of what's happening. And over that time period, the downward pressure on profitability was huge. Think about it. Over the last 10, 15, 20 years, you're paying your staff more to have good staff and keep them, especially in the most recent period. You can't mark up the drugs as much because the cost to you is so much higher now. And other costs are coming up, squeezing that bottom line. And so if any of this resonates with you, you might be a no-low practice. It's not a judgment call. You can still be a great practice. You're just not financially healthy. So these are some of the symptoms for that no-low practice. And if this sounds like your practice, it might be time to do a valuation for management and planning purposes. I'll talk about that a little more towards the end. So coming back to profit, there's a difference between profit and cash flow. So profit, remember, we're looking at as if you don't own the business. It's that money, there's no debts, and we've removed all the owner perks and one-time expenses. You can have a profitable practice that's cash flow poor, leaning on the line of credit, having problems making payments, because you've got debt service that has to do there. You've got the owner maybe taking out too much money for all the owner's perks, and it's leaving the practice with tight cash. So that's kind of one of the risks of looking at profit, but you also have to look at that cash flow. If cash flow's tight, that cash flow tight doesn't necessarily mean you're not profitable. It's an indicator that, yeah, there's a problem, but it might not be profitability. The other comment on profit that I want to add in, lately the term EBITDA has been growing because of the increasing in use in the profession, largely due to, it's the term that the corporate buyers like to reference to. Oh, what's your EBITDA? Profits are essentially EBITDA. EBITDA is an acronym. It stands for earnings, or the profit, before we pay interest, before paying taxes, before amortization and depreciation, which is essentially the adjusted bottom line. So when we're looking at a practice's financial health, assessing the profitability, that is essentially looking at an EBITDA. When we value, it's slightly different, but they're pretty parallel and essentially the same. So from this foundation, fixed cost business, profit's the key in what we're trying to assess. So let's go into then what we do and what we look at when we're trying to diagnose. So we look at the average practice, 10 to 12% profitable. Well, if your bottom line's 10%, we want 14 to 18, let's say 16. 16 minus 10, there's 6%, right? It's not getting to the bottom line. We have the perfect tool already created. It's my full blood panel. When you look at a full blood panel, you know what's out of line because you know those reference numbers, and not just because now they're color coded. You know what to look at. This is my blood panel. And tonight, I want to teach you what it is we're looking at so you can do it to yourself. So if in this case, our bottom line is 6.4%, we want to get to 14. Where's the missing 8? If it's not on the bottom line, it has to be somewhere up above. And so we start, when we assess profitability and diagnostics from that, we look at everything as a percent of revenue. That's the great equalizer. So we can look at this and say $78,000, wow, that's a lot of rent, but it's only 5% of revenues. Most practices, the rent, once you adjust it to a fair market basis, it'll be 5 to 6, maybe up to 8%. I have other practices that their rent is $200,000. But if it's 4 to 6% of revenue, it's not a problem. Higher revenue pays for higher facility costs. Rarely other than rent, if you overbuilt and you haven't grown into it yet, yes, rent's going to be an issue. And the only solution then is to grow. So rent might be an issue, but rarely is it anything on the bottom half of the income statement, meaning the facility costs, the advertising, office, etc. So that sends us up to look at the top. The first thing that jumps out, me, is the number one problem for most practices. Now, we call it cost of professional services. On your tax return, this is usually called costs of goods sold. These are your variable expenses: drugs, medical supplies, reference lab, in-house lab, parasiticides, pet foods, etc. In this case, it's 27.8%. The target range for most small animal practices is 22 to 25%, maybe 26. This is almost 28. So we just found 2 or 3%, maybe more. We don't know why it's high, but we know where to look. So that's number one. Number two, support staff in this practice, almost 25%. The target range for most practices is 17 to 19%. So this is the sum of the W-2s for the non-doctor staff. 17 to 19%, it can be higher, it can be lower. We're going to talk about it further. Where this practice was located, it should have been around 19, maybe 20%. So we just found 4 or 5 more percent that's not getting to the bottom line. When we start seeing multiple areas that are high as a percent of revenue, right? It's percent of revenue, numerator, denominator. Maybe it's not the expense, maybe it's the revenues, suppressed revenues. So now we have a practice that's 6% profitable. And instead of saying, go heal yourself, we can say, okay, we need to look at staffing, need to look at inventory management and suppressed revenues, not necessarily fees, but revenue suppression. And we're going to look into each of those further as we go through this session. But I want to take a step to the side because this is the process I go through. You can do this yourself. You have your financial statements and it's your practice, so you should know. In other words, and this is a very basic profit and loss statement, kind of a generic one from what the QuickBooks will print out. We've got the revenues at the top, and then we have all of the expenses. You can make the edits for that which you know about because it's your practice. For example, auto expense. Do you really need, are you providing in-home care worth $33,800? Expenses? Probably not. That's your car. That's profit. Remove it and redo the math. Basic spreadsheet. Drug purchases, $435,000. Well, do you have any personal expenses in there? You know, I see the owner's boat or the cabin, or they just bought a new X-ray system, $40,000, $50,000, and buried it in drugs and supplies. One-time expenses. You would know if they're there, or you've got your home horses paid by the practice, or you raise pugs and that's in there. Look at it from the perspective, if somebody else owned the business, would they pay those expenses for you? Probably not. So you can remove that, review it and remove it, and redo the math. Insurances, the common ones we see. If you as owner are getting extra insurances over and above what anyone else on the team gets, that's profit. So your long-term care insurance, extra owner life insurance, extra health insurance for your family that associates and the rest of the staff do not get. On the rest of it, then we can look at the rent, setting a reasonable rent instead of a tax strategy rent. One of the ways that we tend to look at that, what's the value of your real estate? So you can talk to local real estate agents, and they'll, especially if they're friends or colleagues, and they'll give you an estimate for the building and land, comparing it to other professional office space. Veterinary office space is not worth more because it's veterinary unless it's new construction. So if they come back and they say, yeah, it's worth about $500,000. Okay, take 9%. $45,000 a year represents a reasonable return on owning that real estate, and it covers the mortgage as if it were sold. So that gives you, instead of 146,000, change it to 45,000. Your salary for the officer or owner, adjust it to production in line with going rates in the community. If you're producing $1 million, you can't get away paying that $100,000 only. Probably going to be $180,000 to $200,000. So looking at it on a production basis. Salaries for staff. If you've got kids on payroll or doing work and not getting paid, you can make those adjustments. Telephone, your personal cell phone plans, if it's being paid by the practice. So making all of these adjustments yourself, it's akin to your clients Dr. Googling themselves, right? It's risky, and they come in thinking they know more than they do. Well, I'm teaching you how to financially Google yourself, which sounds odd. So if you're going to do this, you have to be careful and recognize it for it's a do-it-yourself project. It's not the level of analysis that we or another appraiser would do. So, but it's a good way to at least start and then compare your categories to the areas that we're talking about here. So the main financial diseases that we see, having valued over the many thousand practices over the last 20 years, these are the 4 categories, and they are in order. So first, your variable expenses, cost of professional services or cost of goods sold. That's the #1 issue that almost every practice struggles. I was working in 3 different practice valuations today, and all of them were over 31 or 32% of revenue. That's a problem. Professional staff for practices that have multiple doctors is #2. Support staff, #3, and #4 is revenues. I'm not a big fan of, oh, your profit's low, go raise your fees. No, you might be putting a Band-Aid on a serious wound that's systemic. And raising fees is just going to make it look better without healing the practice. So what we're going to go through next is each one of these categories and some of the common fixes as well as the diagnostic components within them. So first, cost of professional services. Your variable expenses, and as I mentioned, the target range is 22 to 25%. Can be up to 26%, especially if you are have a significant boarding component, or maybe grooming or a big pet product display or space in your practice. You get into mixed animal practices, large animal, food animal practices, it can go upwards of 40, 50% or higher if you're drop shipping. So When it's high, what do we look at? We know it's over 25%, but why? Number one is inventory management. So that can be how you order, how often you order. Are you buying 3 months supply because that's what 6 months because that's what you always did? Yeah, 10, 15 years ago, a 3 month supply was probably a good strategy. But now, because when they said 6 to 8 weeks shipping and handling, they meant 6 to 8 weeks. Now, if you order it today, you're going to have it by Saturday or Monday. So getting that turnover, increasing how frequently you are ordering and ordering less. That's a key. I'm not an inventory specialist. A lot of folks have written good articles on that. Marcia Heinke has a lot of good information on that. Denise Tumblin as well has written a lot. Karen Felstead. There's Amanda Donnelly, Louise Don, a lot of my colleagues have written on this. And I think inventory management, folks just are not paying enough attention to it. You have somebody on your team doing it, but you're not teaching them how to do it. So they just order. And the other than how frequently you're ordering and the turnover, we've got depth and breadth issues. Depth being how much you're ordering. Breadth is what you're ordering. I'm a pet owner. If I take my cat, that was our office cat. We had to put him down last fall for old age. But Smudge, when I take him to our doctor in town, I want them to say, this is the parasite control you should be using. Not, oh, we've got 4. Let's talk about, no. I want your advice on what to use, not the choices. And if I want a special order, you've got an online pharmacy, I can order it through there because I need something special. You don't have to carry every pet food, every parasiticide. When you have multiple doctors, it gets hard too, because Dr. A likes drug 1, 2, and 7. Dr. B likes drugs 13, 6, and 21. Dr. C likes, you see where I'm going, you end up carrying 8 different things. For efficacy wise, you might be able to get that down to 3 and special order it when you need it. So that depth and breadth is a key component of this. Markups, that's a component as well, but I think we need to fix the ordering. If you're not using vetcove.com, you might want to try VETCOVE, VictorEcho.com. When this first came out a couple of years ago, I was like, I don't know. But now I've had many clients use this and they really do like it. You're not ordering from VetCove, you're ordering through them. So if you get special pricing, you're going to see your special pricing. When you say I like it for 3 main reasons. Number 1, it's free. Free is good. Number 2 is that it saves time and money, one-stop shopping. So you put in your Penn Vet number, you put in your Miller Vet, your MWI, Midwest, Patterson, Covetrus numbers. And if you get special pricing, because you're in a group, it will show you that. And then you put in what you want to buy. 3 boxes, 3cc syringes. It shows you everyone that's selling that and how much it is. So instantly you're getting that, all the prices on one site. And when you buy it, it goes to that company's shopping cart and you check out with that company. Which leads to the third reason I like this. It removes emotion. Oh, we always order from Debbie because she's so nice and brings us donuts. No, Debbie still sees your order, but now you're getting things at the best prices. And her order might be a little smaller, but she still sees the orders. So you're not getting anyone's nose out of joint. It's really good for that one-stop shopping. It's not necessarily as good for those times when you're working with the rep to do buy one, get one, or bulk special pricing, delay billing, those kinds of things. You still want to talk to your rep directly. But I've had several clients pick up 1 or 2% of revenue simply from using that service. And it's free because the corporations have to pay. And they're just aggregating data. So that can be something to help as well. When it's high as a percent of revenue, we don't know, like I said, we don't know why. And we don't know where. Is it the lab? Is it your reference lab? Your drugs themselves? We're not sure. So the tool to do, and this is my #1 favorite tool for this account, is looking at income to expense ratios. And there are ratios for everything. This comes from AHA's Vital Statistics series. We're working on with AHA, Louise Dunn and myself, to help make this into a more active tool, which will be pretty exciting. But right now, what this is it helps you refine and break your drugs and medical supplies into subcategories to tell which are the ones that are out. So you look at your revenues, pharmacy revenues, divided by the pharmacy expense should be 2.5% or greater. Or not percent, 2.5 or greater. In other words, the revenues are 2.5 times the expense. In-house lab, 6 or greater. Reference lab, 3 or greater. Now, if you don't have in-house and reference split, the average for combining lab as a whole, the target ratio is 4 to 4.5. One quick comment on that. Some folks look at that and they say lab at 6 times. Does that mean I have to mark up my lab 6? I can't do. No, we're not talking markups because we're looking in aggregate. Some lab you might mark up 1.2 because it's really expensive. Others you might mark up 12 or 20 because there's hardly any expense there at all, but there's value. In aggregate, it'll be 6, it should be 6 or greater. So here's an example I'll walk through to show you the math. On a profit and loss statement or in your revenue by category report, you can get the revenue information. So in this case, we have lab services in-house and lab reference lab or outhouse, but we're using the combined because on the expense side, they didn't have that separated. We have our pharmacy revenues. So we build the chart. We have our lab, pharmacy, heartworm, flea tick, and dietary. Then we go to the other part of the P&L to pick up the expense information. You can see their lab information is 3 different categories not matching up. So we use the whole. And our pharmacy, we can add that to the table and then take the revenue divided by the expense equals the ratio. So we have in this practice, there's the target. Now for this practice, their cost of professional services was high, 28%. We don't know where, but now we know it's not in foods. They're at 1.44, and 1.4 is good. And heartworm is about 0.5% low. They're parasiticides. Pharmacy is only a little bit low. And lab is still 0.2 down. So the practice manager, instead of saying, oh, fix the inventory, now they can sit down and say, okay, because of volume, let's look at lab, because that's $500,000 of revenue. And then let's look at our parasiticides and pharmacy, and they can budget time to then go in and look further. In this particular practice, they did. A year later, they improved the lab. It went from 3.8 to 4.0. Pharmacy took a little step backwards, 2.3 to 2.2, and flea tick heartworm went up from 1.4 to almost 1.7. So they started fine tuning because of this. Now, one other comment on these ratios, and there are others. There's ratios for surgery, there's ratio for x-rays, etc. The pet foods ratio, if your focus on pet foods is nutraceuticals only, your alphabet diets, KDRD, etc., veterinary diets, then I often see this down around 1.2, 1.25, and that can be normal, mainly because you apply a low markup, so you get adoption. And it's intentional, and especially when it's chronic use for the rest of their pet's life. So putting that in, that can be okay. Now, if you're selling regular diets as well, and you're down around 1.2, that's not necessarily good. So just a little caveat on that. Coming back now, if you're still over 22.5%, now we need to look at inventory control and embezzlement. Now, I talk to a lot of practices and they say, oh yeah, product creep, yeah, of course, yeah, it's there. That's theft, folks. And it happens to us once or twice a year. We see that this category is too high. We start asking questions. It's been 3 times this year. We start asking questions. Well, why is this high? And another indicator that something not right's going on. This should be stable as a percent of revenue. If you're high, 27.5%, it should always be 27.8, 27.4, 27.5, 28, 27. It should be fairly consistent over the years. If you see it going 24%, 26.8%, 28.9%, that's an indicator that maybe, yeah, your fees aren't staying current, your expenses went up and you missed making the markup adjustments, or theft, period. That's the indicator of theft, because their confidence grows, they start stealing more, you have all of the expense and none of the revenues. As a percent of revenue, it starts going up. And that's a problem, and one of the indicators we see. And we had it happen 3 times this year. One was cash skimming. One was a terrible, almost $100,000 plus, that the practice manager was skimming cash, having the practice pay for personal expenses and burying it in bookkeeping and ordering product and diverting. And I had another one that just found we raised the questions, they went and looked and found $60,000 in the last 2 years each, 60,000, and is only now starting to crack the box. So it does happen. And it's always the ones you trust. So trust but verify. And again, there's better articles out there on embezzlement and control. But the one thing that makes me scratch my head and worry, if you are computerized, you have an awesome tool and you're not using it. Like when I speak at North American VMX, Western Veterinary Conference, a room full of people, I say, how many of you, if you called back to your office and said, print me an inventory report, you know it would match what's on the shelves? Oh no, it never matches. You have it and you're not even using it. At a minimum, you should be using your software, practice management software, for your pet foods and your parasiticides, the easiest stuff that gets stolen or purchased, but then diverted. Go back to your computer, true up, print the report, and if it doesn't match, force it to match at the beginning of the next month, September. At the end of September, print the report again. If it doesn't match for pet foods and parasiticides, there's only 3 reasons. Human error. Yeah, they got 16 cans and they only put it in as 1. Well, you can fix that. That's education. 2, computer error. The computer isn't correctly debiting the codes. You put this in and it doesn't always subtract it. You can fix that. The 3rd reason is theft. And sometimes just the fact that you're paying attention to it will correct the problem. So I do recommend at a minimum using your computer system for pet foods and parasiticides, because that's just, you have all of the expense and none of the revenue. And then when it's high as a percent of revenue, it could be your markups and the discounts. We'll talk more about discounts later, but your markups need to be fair to the practice. And one of the things to whoever's managing this needs to understand, a markup is not profit. Everything the practice does, whether it's a product or a service, everything you do, every dollar generated has to contribute to your rent, to your phones, your electricity, to your workers' compensation insurance, professional liability, business overhead insurance, payroll taxes, payroll. And so that markup is paying for the office's expenses. The profit is just a wee little bit of that markup, maybe. But sometimes your staff think, oh yeah, Doc marked it up $20. That's all profit for her or him, I guess. No, it's not. That's going to pay them, but they don't understand that. So educating them might play a role in there. I often hear and get questions, well, but what about price matching? Should we be doing this? Because they can get it online a lot cheaper. Short answer, no. Knock it off. You can't oftentimes buy it for what they can sell it for. And no sense trying to compete with them. You can maybe get close, but no, stop price matching. Or if you do it, make them ask for it. Don't advertise it. I mean, let's look at the math here. If we take, let's say you buy 50,000 with a product, 100% markup, your profit's going to be 50,000. But you say, oh, but I don't want to mark it up because I need to compete with them. And so you mark it up 70%. You're losing $15,000 in profit because you think you're going to lose clients. They're going to go somewhere else. Let them go somewhere else. Let them go to your online store, have a different price there than in the office. I mean, think about it. If you lose 5% of your clients and they're going to go somewhere else, you lose 20% of that. You're going to make $40,000 instead of $50,000. Which is greater, $40,000 or $35,000? Order less, sell less, but get the full due to the practice. Take care of the practice within that, in my opinion. So stop worrying about the other. You can still provide a good service, good education. You don't have to advertise the price matching. So professional staff, I want to spend a couple minutes on this. Typically, professional staff, the doctors should be paid 18 to 22% of their production. The target range for as a percent of revenue for all doctors, including the owner, is going to be in that 19 to 22% of revenue range. So when it's high, we want to look at their compensation. Every doctor needs to produce 4 to 5 times their costs. Otherwise, if not, they're not producing enough to cover their expenses. The practice either has to fire them. Now, granted, I recognize finding a doctor right now is incredibly difficult. I get that. This is in absence of that. But if they're only producing 3 times their cost, you're overpaying them. Now, I have some doctors say, yeah, I know that, but they take the weekends and evenings that I don't like. They make my life easier. Okay, you're doing it for a reason. The consequence will be you're less profitable, less valuable, but I understand the reason. And you're cognitively making a decision. That's fine. If they're producing 6 times their cost, you got the opportunity to be a hero. Hey, can I give you a raise? Because you're doing great and I want to keep you. And maybe they're less likely to be looking over the fence to see the grass is greener, and you're going to lose them to corporate and those large signing bonuses that seem to be creeping up. So that 4 to 5 times the cost is key. If you pay on production, you want to review what counts towards production. So if you're paying them 20, 21, 22% of the production, that should not include pet foods, parasiticides, because you don't have enough markup to pay that. And oftentimes, a lot of the employment contracts I see lately in the last several years have excluded your most expensive drugs. Again, because the markup's not there. So what counts towards production? If you are paying on production, there's no raise. It's not, oh, I'm going to pay you 20%. Now I want to be paid 21%. No, every time I raise my service fees, I'm giving you a raise. And I promise to do that at least annually. So they're getting built-in raises when they're on pure production. One of the tips that I like, especially for practice owners and managers, at least once a year, review all of your doctors' W-2s by their production. So this we're looking at essentially as if they were paid on production. What's their effective compensation? Their W-2 was X, they produced this, that's the production. And if you review this and review it across all of your doctors, you can look, are we paying them what we think we're paying them? So for example, here's a chart. We've got 6 doctors, and the left-hand column is what their W-2 was, how much they were paid. We've got their production. We can divide their compensation by their production, and we can see we've got a pretty wide range. We've got most of the doctors are in that 25 to 27% range. But Dr. B at the bottom is receiving effectively 30% production, and Dr. N is getting 42% production. Now, fortunately, the doctors are not talking with each other. They're not comparing W-2s, but we've got good questions to ask. Now, if this was your data, you might know, oh, well, of course, Dr. N and Dr. B, they're new grads. And so they haven't grown into their salary yet. Yeah, that's fine. We're good. But if that's not the case, or maybe they're relief or they're filling in special niches, but if you don't have a reason, there's something to look at. There's another practice that we had where we've got a range of 19% to 38%. Now, 38, that's the relief doctor, right? That's the second from the bottom. But we've got their top producer making the least amount of money. The doctor that produced the most, Dr. W, produced $408,000 and was only paid $79,000. Where right above Dr. W, Dr. I produced almost $100,000 less and was paid essentially the same. That might not be equitable. In which case, if they figure out or they start thinking, I'm not paid appropriately, you could lose a good doctor because you're not paying attention. So professional staff, once we adjust you as a doctor, we're looking at that 18 to 22% of revenue range. It can be higher depending on where you're located within your state, or if you have large animal ambulatory components, that can distort this. So you might want to look at large animal doctors separate from small animal doctors. Specialists, that can shift that maybe upwards of 25%. And yes, the question that came up that you need to sign off, will recording, and I see that I answered, but we will have that afterwards. So it'll be posted to our YouTube channel. The other comment to look at, are doctors producing enough? Are they utilizing the team? How can you help them work smarter? Now, you can't, unfortunately, you can't go to them and say, look, you're not producing enough. I'm overpaying you. You have to kind of spin it from the business side to the good medicine side. You're a great doctor. There are more pets that need to see you. What can we do to help you to squeeze one more in a day? Because we've got to try and they need you, and spin it more towards trying to help them, provide maybe some more mentorship, especially with younger doctors. All younger doctors, most doctors were techs first. And so by default, they're in the room, they're like, the tech's not here, I'll just do it myself. Or the tech is there and they're still doing it themselves. Got to break that habit. Doctors need to be charting, prescribing, doing callbacks, doing surgery. That's it. Anything else, they should be delegating so that they can take care of more pets, practice more medicine, because that's in the practice's business side best interest. Now we look at support staff. Support staff as a percent of revenues, typically 17 to 19% is the target. These are the sum of the W-2s divided by your revenues. Some of the other data that's out there says, it should be 24 to 26%. But that's W-2s plus payroll taxes plus benefits. Because there's variety, especially in benefits, I look just at W-2s divided by the revenues. 17 to 19%. That can vary within each state. Looking at Virginia, for example, one of my states, Northern Virginia, it might be 20 to 22% because of cost of living and hiring and competition for good employees. But if you get into Southern and some of the periphery down towards Roanoke or across the bottom, 14 to 16 might be viable and a healthy practice and stable. So when looking at your own numbers, you can certainly contact a veterinary appraiser or a broker that works in your area and say, hey, this is where I am. What should my support staff typically be? Now you're asking us to diagnose over the phone, which is dangerous for you and for us, but it'll give you a reference point to help. When it's hot, it can be compensation. So not to say they're overpaid, it could be their scheduling's not good. Looking at overtime use, a raise, folks, a raise for a raise's sake should never happen. I'm not going to pay you more just because you lasted the last 12 months with me. You want to make more? Great. Come on in. Let's talk about job responsibilities. We can have you do more. I'll definitely pay you more. Cost of living adjustment, yeah, that's appropriate, but that's only been maybe 2% per year lately. A survival raise, you less than 12 months, you're going to get an extra 50 cents. No, that's not fair to the practice. Anytime you give any raise, there needs to be an immediate and corresponding fee increase. We're going to pay you more, we got to charge more. That's fair to the business, which is fair to them for long-term employment. Another component of this is the employee discounts. Because that a lot of reason, one of the main reasons employees stay is because they have a lot of pets. And frankly, at least the practices I look at, the employees don't always have, shall we say, the healthiest pets or the fewest. And so even within employee discounts, is it equitable across your employees? If I'm one of your employees and I don't have a pet, and yet my colleague here's got 6 and is taking $1,200 a year as an employee discount benefit, I'm not getting anything. How equitable is that? So I'm only pointing a lump or pointing a light at the bump in the rug, because there's a lot more to trying to fix that. You also want to look at team efficiency and utilization. Are the vet techs, the licensed techs, using the assistants? Are the doctors using the techs? So that everybody's contributing and doing as much as possible to work efficiently. And scheduling, I mentioned that. You know, a lot of practices, yeah, the team shows up at 7:30, but they don't start seeing clients to 8 or 8:30, but the whole team is there. You know, can we have one come in at 7:30, another one at 7:45, and then the others at 8, and we start seeing clients at 8:15? Are they doing work when they're there? Overtime use. You know, overtime should be a Band-Aid, temporary use only. If you're consistently using it, it's time to reassess the schedule and possibly the hiring. Other than in moments when, yeah, we can't find anybody. Oh, I get that. And techs and doctors right now, if I had 100 of them, in less than a day, I could probably place all 100 doctors and 100 techs with my clients. So, and then if you have legacy employees, we'll see this high as a percent of revenue. Just because they're expensive, they're hitting that ceiling of compensation. And then if you've got multiple ones, when this one's on vacation, this one's filling in and getting overtime, and it's expensive. And the only way to heal that is turnover. So it just becomes a cost of doing business. But if you have that, you should be providing exceptional client service. So maybe your fee should be a little bit on the higher side too. There's no one answer for any of this. On the revenues, after looking at all the other areas, then yes, we're going to start looking at revenues. And number one is revenue suppression, essentially the discounts. And discounts are either overt or covert. And the overt ones are the obvious. You know, my personal favorite, the multiple pet discount, because you know the entire team worked so much less when they came in with 4 labs. We should give that client a discount. No. You know, I think you can have senior discounts and military discounts, but you don't need to advertise it. Let people ask for it. When setting your discounts, I know for all of you, because you're smart and good thinking people, before you set your discounts, you went and assessed your profitability, right? So you know what your profit is. You knew how much discount you could provide. If you're average 10%, your maximum discount is 10%, right? You can't go higher than that. If you're 6% profitable, your maximum discount's 6%. No, most practices don't look at profitability to set their discounts. They just set traditional discounts. That's pretty dangerous. The covert discounts are a lot harder, because this is the gee, I feel guilty discount. And that plagues most doctors their entire career. When they're new doctors, new procedures, oh, how can I charge them $250 for that ultrasound study? I'm learning on their pet. Or an experienced doctor learning new surgical skills. How can I charge for that? I'm learning on their pet. Versus the experienced doctor that comes in and the ultrasound, zip, zip, less than a minute. And they're like, yep, that's what I thought. How can I charge them $250 for that? I wasn't even in there a minute. Is medicine being practiced to the benefit of the pet? Yes. Then a discount is not warranted. but that guilt is still there. And you have to come up with a strategy to undo that, because it's not fair to the practice and the clients. Certainly missed charges. If you have not done a medical record audit recently, you might want to do it. It'd be a great exercise for your team leaders. For a week, print out 2 invoices for every transaction, one to the client, one to the box underneath the counter. At the end of the week, buy some pizza and beer or soda pop, bring your team together, take those invoices and distribute them. Not products, but service transactions. Everyone goes to a computer and looks up the record. Is everything that was in the computer on the record? If not, why not? What was missing? And who was involved? Missed charges, you can't go back to the client, and we're not slapping the hand of the person involved. They made it, it's an educational moment. We've got a teachable moment to help fix that behavior and stop it. Also, is everything on the record in the invoice and everything in the invoice in the record? Because if it's in the invoice and not the record, you got a potential liability issue. So that wasn't documented. So usually in medical record audits, you'll find stuff pretty quickly. And that's an opportunity to fix them, so you're not giving those free discounts. At a minimum, you need to track your discounts. That enables you to say, okay, we gave $70,000 away last year. Is that what we want to? And I've had clients say, yeah, that's part of our practice. That's what we're going to do. We're not changing it. Okay, great. You made a cognitive decision to do that. Versus, I had no idea we were giving that much away. That's why we're not profitable. So track it and then review it to make sure. One of the things on the revenue side, on the fees especially, are your fees current? What I like, if you're not current, what I recommend, now this is a Band-Aid, it just helps you bridge the gap to the next adjustment, but print out your revenue by frequency. So your services by frequency and your products by frequency. Typically, these will be the top 20, 25, 50 services most frequently done. And you sit down, top 25, and you say, okay, I'm going to adjust 20 of these. Add $1 here. If your fees are not round numbers, add odd numbers. $1.17, 96 cents. And if you adjust 20 out of the top 25, they think, oh, I'm only adding $1. Yeah, but if you did it 2,000 times last quarter, you just added $2,000 to the top line and the bottom line, and nobody noticed because it was just odd random numbers. It was not an across-the-board fee increase. So you can do this if you feel your fees are behind and you're afraid to do a full fee increase. This is a nice way to bridge the gap, and nobody really notices. The other comment on this, fee sensitivity. Your clients are not fee sensitive. They're not. The fact they came back to see you multiple times means your fees are not relevant to their decision. Your staff, fee sensitivity, yeah, probably. So one of the things I recommend is to quantify this for them. Quantify, because the staff and you are afraid that clients, we remember the negative. It's human nature. We remember that client that got all upset because of the fees. We don't remember the other hundreds of clients that said, oh yeah, here you go, and pay for it. That's great, and happy as a lark for everything they received, regardless of the invoice. So what I recommend, next time you raise the fees, and again, this is a teachable moment for the team. Get the team to participate. We're going to raise our fees. We've got to, our costs have gone up. All our fees are going up 5% on Monday. But what I want to do is let's track our complaints. Wherever you collect the money, at the front desk or in the rooms, outside the exam room, put up a little piece of paper. And for every client that complains, put a hash mark on that paper. Oh, your fees went up. That's not a complaint. That's a statement of fact. Educate your team so that they can respond accordingly. Why, yes, unfortunately, we did have to raise our fees. Our costs have gone up. And in order to continue to provide the quality care you expect, we had to make a small adjustment. That's a complaint. That gets a check mark. At the end of a week, run it 2 weeks. You're going to get bored of it. But at the end of a week, count up how many hash marks are on that piece of paper and divide it by the number of invoices. It will not be more than 2%. 1 out of 50 clients complained. But that's what we remember. Now, some of you may say, oh, but yeah, my clients are passive aggressive and they're going to pay and not say anything and then go back and give us a negative review. Okay, well, let's double it. 4%, round up, 5% of clients complained. Heck, go 10% of clients complained. 1 in 10. Do you want to set your fees and your team to focus on the one that complained or the 9 others that thought you walked on water and think you're the best service in town? Exactly. So this quantifies it because your employees and you don't have a sense how many like what you're doing versus how many really complain. And that, keeping track after your next fee increase can be a good exercise for the entire team. Some of the other subtle diseases that we see when we're looking at this: poor communication of value. You're not educating your clients. The team is not educating the clients. Reinforce message across all levels of the team: doctors, techs, assistants, reception, etc. And inconsistencies across the levels. They see one doctor that says, let's do this, another doctor, or especially if clients call in and say, oh, I want to see Dr. S because it's always less expensive. Well, now you got to practice within a practice, and that's problematic too. It should be consistent across all of them. Another issue we see is this inappreciation syndrome, especially with long-term staff. You make my life easy, I'm going to pay you more. And increase time off and allow them to do and get away with things. And it's really nice, but it will make you less profitable. And that's a problem because it decreases the profitability, decreases the practice value. When it comes time to sell the practice, you're passing that problem on to the next person. They can't remove those benefits and undo that. We can't make that kind of adjustment. So there's other ways to reward the team through bonuses, through special events and things. It doesn't necessarily have to be through their W-2. So monitoring. Key statistics. Now we know, what to do to diagnose and some of the things to try and fix and heal the practice. But on an ongoing basis, I want to share my favorite KPIs and some of the ones we've already mentioned, but we'll walk through that. So number one is all of your expenses as a percent of revenue. That's, I think, fundamental. And towards that end, are you using a good profit and loss statement? Or is it just a general statement that looks something like this? It's a default statement. The left-hand number column is year to date, which on a full year, it's the same numbers in both columns. And then you look at this and it's organized, it's alphabetical. Advertising and auto as your top expenses that you should be looking at. Salaries and supplies all the way down. That's ugly and not an effective tool. Versus if you have a chart of accounts, if not, play out the year with the account with your organization you have. Plan on the beginning of January, switching over to a better chart of accounts. The chart of accounts, it just provides a structure for organizing your revenues and expenses. And because QuickBooks or Quicken and all of these sort this alphanumerically. Well, if you put numbers in front of it, you can force it to sort it in the order that you want. For example, here's one. This is the practice that we looked at for the income expense ratios. They have their revenue categories. They have their costs of goods sold right at the top. And then they've got payroll all together by category. Granted, this is a larger practice. This much detail might not be needed for a 1.5 doctor practice, but you could still have revenues by category, drugs and supplies, and then doctors and support staff, and have something a little bit better. At a minimum, if you're using QuickBooks and your chart looks something like this, next time you're in and printing your P&L, for any of you, that go into the report properties. So you print up the report. You're looking at it on the screen. There'll be a report properties box, and it'll pop up a window, something like this. You can put two check boxes. Number one, previous period. Sometimes it says prior period. If you put a checkbox in that, now you'll get your target data, and right next to that will be the same period. So if you're looking at January through June 2021, there'll be January through June 2020. So you've got instant comparison within there. And then if you put a checkbox in percent of income, sometimes it might be common sizing, but that will instantly give you everything as a percent of revenue right on your P&L. So you don't need the calculator now, you've got that. And when you start comparing one period to another period between those, don't look at the dollar amount, look at the percent of revenue. That's the great equalizer. So within the key KPIs, looking at that percent of revenue right away should start becoming a habit. We already talked about the income to expense ratio. I like this, as I had mentioned previously, but part of this is becoming familiar with it for the main ones that you want to track, like lab and maybe parasiticides, and then look at it on a regular basis. If you know your lab, because you're going to get familiarity with that, if you know lab normally is about 4 to 4.2, and you look at that every month and it's 4, 4.1, 3.9, 4.2, 2.7, what? Red flag, because you have that sensitivity. So now you know something changed. You caught it within 30 days. So you know to go back, what changed? And maybe the reference lab raised their fees and somebody forgot to put it into the computer. You caught it quickly instead of 6 months later. Another one, which we talked about, is tracking your discounts. Are you giving away what you intend to give away? Because remember, discounts are top line and bottom line only. None of your expenses change. The other one I like, and this one is growing, we keep finding more and more ways to look at this, but your revenue by category reports. And I want to go through a couple of ways you can use this. First, one of the most basic, print your revenue by category report, and then look at the sum of your service revenues compared to your product revenues. And that where those are balanced. Focus on the product revenues. Add your pharmacy, flea tick, heartworm, food, vaccine revenues. If you have significant over-the-counter, that goes in here as well. If that's greater than 40% of your revenues, you are product-centric practice. No pros or cons or negatives. It's just, that's what you are. It is harder to be profitable when you are a product-centric practice because you have less of a markup. High volume, low cost is hard to be profitable when you're focusing on the product side. Changing that can be done, but it requires the team to do it because you need to focus on now more medicine, more diagnostics. I'm not talking about padding invoices. I'm talking about more medicine, more care, more services, client education to get the pets in annually, some pricing adjustments. The other component on product versus services to give consideration to is, are you treating illness or do you treat wellness? Reactive, you're waiting for animals to get sick. Yes, you're going to provide a lot of medicine when that happens, but most of your clients have healthy pets. To keep them healthy, being proactive in the care, preventive care, wellness care, the big three areas I see as opportunities for practices, oral health. I am a huge fan of that because I know my home cat, Jack, lived to be about 19 and a half, and oral health was a big part of that. Nutrition. There's a lot of obese pets. You know, I'm preaching to the choir here. And cats, number 3. Yeah, I'm a cat fan. I travel too much for dogs. But cats are completely underserved. Now, all of those require client education and a relationship and back and forth in order to do that. But it's good medicine and it's the pet's best interest. Because that wellness preventive care is about building that relationship. So The other component besides service and product ratio, I like the revenue by category report, because if you take the revenues for the service or product and you divide it by the frequency, that comes up with the average fee, right? What should that match? Should match your fee schedule, right? So here, just as an example, we've got a practice here. And if we take the annual physical exam, they generated $70,900 and they did it 1,272 times. You divide the revenue by the expense, $55.86, roughly $56. If this practice's exam fee is $56, great. If their exam fee and the fee schedule is $60, we have a problem. There's some discounting going on because we're not getting all the revenues. We did it 1,200 times, and on average, we're $4 short each time. 1,200 times $4, that's $4,800 that the practice gave away without realizing that. So your revenue by category has the revenues and the frequency. You can use this as a means to assess yourself. I think for small animal practices, revenue by frequency, revenue and frequency, looking at your exam fees, your medical appointments, and tech appointments, if you do those, the revenues divided by the frequency. Within the treatment areas, these are the key areas that we see the most frequent misses and mischarges within that. In-house diagnostics, definitely fecals. Radiographs. On the large animal side, if you have an ambulatory component, ER, C-sections, because that's where these tend to get missed. And you're just giving away revenues. You're doing all the work and you're not getting paid. You can look at other areas and maybe spot check them within yourself, but these are the most common ones that should be looked at fairly regularly. Other KPIs, number of invoices, and certainly reviewing this year to year. Is it on track? If it drops, numbers of invoices, why did it drop? Were we maxed out? One doctor was out on maternity or what injury, or you have a reason it dropped down. The other way to look at this is a measure of your efficiency. And I imagine that this year, if you looked at this measure of efficiency, it would be much improved over last year because most practices are just swamped trying to help as many folks as they can, many pets. As a measure of efficiency, to look at that, you look at take a week and look at the total staff hours. How many hours did each doctor work, each employee work, business manager, if the janitor's on payroll, janitor included. The sum of the entire team's hours for that week divided by the number of invoices that you had. The general goal is 1.3 hours per invoice. In concept, about a half hour for each invoice for the doctor and 1 hour for the staff combined. If it's higher than 2, it starts raising. Essentially, we're looking at this as table turnovers, right? If you're a waiter, and many of us have done that, every time I turn over that table, I'm getting paid through my tips. So this, we're looking at how can we work smarter, not harder, take care of more pets with the same team, and show evidence of making improvement. Now, you can also look at doctor hours per invoice, support staff per invoice within that. But that helps diagnose, are we doing as much as maybe we could? I've got another chart or assessment for that as well. Certainly looking at new client numbers. If that drops, we've got a problem. So, and more importantly, new clients, you got to change that in your head. Those are not new clients. Those are new customers. They only become a client when they come back another 2 or 3 times. So looking at the trend is nice, but really assessing, are they bonded? Now, some software is starting to track this on your dashboard, but mostly you still have to do it manually. What I like is have one of your receptionists, beginning of each month, they go back 18 months and print out the list of new clients from that month. Over the course of the month, when they have a downtime, they pull each name up and put a check next to all the ones that came back 2 more times. If you take then the count of the new customers that came back twice, 2 more times, over the last 18 months as a percent of the total, that's your bonding rate. If you saw 30 new quote unquote new clients 18 months ago, and only 15 came back, you're running 50%, meaning you're losing half of those new clients. Now it gives you and the team an opportunity to look at and say, well, why are we losing them? We should have gotten 20 to 25 of those 30 clients. And assessing where your clients are coming from, what's the new client experience, instead of just assuming those 30 clients are all new clients. No, they weren't. 15 of those were customers. 15 became clients. Another KPI that I like is the PPI. I call it the Practice Price Index. It's similar to the Consumer Price Index. So what this does is you build a spreadsheet of your top 50 most commonly ordered and used internal supplies. So not things that you sell to clients: caps, gauze, gowns, gloves, printer cartridges, paper, toilet paper, paper towels, a top 50. Then you build that list, and right next to it, you put in how much you would order. These two columns never change. That's your breadbasket, akin to the Consumer Price Index. Then you put today's date and you say, if we ordered that much of that item, what would it cost? And then you have the total for that order, as if you ordered all 50 of those individual items. Then you close it and let it sit. Every 6 months, I think, is a good time. You could look at it quarterly, but you might not see a lot of change. Every 6 months, you open that up. If I ordered the same amount of each one, what would the total cost? The increase from 6 months ago to today's order, you need to apply to all of your service fees. If it went up 0.25%, what that says is your internally consumed items, prices went up 0.25%, you need to increase your service fees 0.25%. What I like about this is you don't have to do this. You can delegate it to some of the leaders you're cultivating. And what's nice about this, you have a staff meeting, and then one of those texts, the receptionist says, oh, hey, I updated our PPI and we need to raise our service fees 0.18%. It's your team telling you to raise the fees because the costs went up, not you raising fees. And so they become aware of internal costs, and they're the ones tracking that. Now you can look at this annually, 6 months, maybe. It doesn't change quickly, but it does change over time. The other KPI, and I reference this a little bit, are you doing what you think you are doing? That internal compliance. Now I want to preface this, but I'm not advocating medicine by statistics. I'm saying let's use the statistics to look at what might be able to be done. So within this, let's say you go back, and there's a practice in January. They did 112 adult exams and 50 senior pet exams, and they had 179 sick patients. The question is, are they practicing consistent medicine on all the pets? And so we can look at dentistry, because that works really well. And you can do this with your own practice. Dentistry, they had 112 adult exams and 50 senior exams. Well, if 70% of pets are over 3 years old, this is basic statistics on the profession. If you are over 3 years old, you are 60% likely to have a dental issue requiring action. So 112 essentially times 42%, that means they should have had potentially 47 dental cases. If you're a senior pet, 80% have an oral health issue requiring action. So they potentially could have done 87 dental procedures. In January, they did 9. Now, if this was your data, you could say, yes, but February's dental month, and we scheduled 70 procedures in February. Okay, you would know that. But if not, why not? Is your team not talking about oral health? When they do a physical exam, are they not looking in the mouth? Are they not advocating for annual dental cleanings. There's an opportunity there that's in the pet's best interest that's being missed. One more dental procedure a week benefits the pet, keeps the team busy and growing, benefits the practice. Wellness exams, 50 senior exams. How many senior screens did they do? Should be 50, right? Why is it only 26? Oh, well, the rest of them scheduled a dental procedure and they're going to have their full panel done as the pre-anesthetic safety check. Well, it's your data, you would know. But if not, there's medicine not being practiced to the detriment of the pet's health. Medical appointments to progress exams. If they had 179 sick patients, roughly 60 medically, statistics-wise, would need a recheck. So they should have done about 108 rechecks. They did 48. They charged for 48. What happened to the other 60? Was it just by phone? Is that acceptable? Is that within your protocols? The standard operating procedure for a medical recheck is, oh, we can do it by phone. We're too busy. Well, there's multiple things there. Dentistry to annual exams. Also looking at fecal to annual exams. There should be, every annual exam should have a fecal, right? If not, why not within there? So it really comes down to, this is looking at those statistics is a way to just assess, are we dropping the ball? Are we missing the opportunity to take care of some of those? So something to look at as we go through. Now, I want to wrap on just a 15-minute monthly routine that you can put in. This, I didn't create this. My colleague in Simmons, Dr. Byron Farquhar, put this together. I made a few refinements. But this sets up a monthly routine. Should only take 15 minutes. If it starts creeping, you're going to stop doing it. And the benefit of this is when you do it more than just a month. Once you get into the second year, you develop sensitivity to these variables that allows you to diagnose when things start going out of whack and your practice is trending in the wrong direction. So what this does is it focuses you on that monthly routine, looking at core data. Prior to starting the clock, you need to have on your desk a year-to-date profit and loss statement. If you are a practice manager and your owner's not sharing that data with you, it'd be nice to try and get them to do so. You have to explain to them why. But practice owners, you don't necessarily have to do this. Your manager could bring them in. Let them, you hire your practice manager to improve the practice, not to maintain the practice. Enable them to do the job, to protect the practice and make it profitable. That should be in their job description, not to keep everything copacetic and just put out fires. You want them being proactive. So the revenue by category reports and general statistics, appointment book, and the same information for the prior year. Start the clock or a timer or whatever. Start with a walk outside. Go to where the clients park. Look around. What's it look like? What's the first impression going to be? If this was a new client coming in here, not picking up poop or cigarette butts or anything else, just looking at it, then going in the front door. I can tell more. I know instantly what I'm going to see when I walk into practice and that first sniff. That sets an impression. What's the decor like? As you walk around the inside, taking a tour, what's a new client's perspective going to be? Are people attentive? Are they busy? Are they doing things? How's the inventory levels look like? And you're walking through the client parts of the practice all the way through the back, not acting on anything, just taking mental notes or actually writing it down, because you can budget the time later to delegate with other people. You know, here's a practice I walked into. This was a very small practice. This reception area, you could see the edge of the door. My back was right up to the counter, the reception counter. And this was nice. It's organized, clean, a little bit of product, a dry erase board, soap opera. Are the receptionists really working? Or are they watching the soap opera? This was nice. And I like this. Yeah, it's a dry erase board. Summer is here, and that means insects, client education. That's good. I was there at the end of September. What's that say to a new client? Here's a practice counter. I like this. Donate your towels. Help us help pets. But what's that? How old is that? Or doctor will be with you in a minute. Sit, stay. How old is that? Clients can't judge your medicine. They judge the subconscious components of the experience. What does this tell them about your medicine? You can't keep this current. How long would it take to lift that up and put a new one down? Attention to detail, right? Okay, folks, this is dead. That should not be anywhere near the client side. Change it. It's not going to be costly, or have an arrangement with the local flower companies or funeral parlors that they bring the flowers in once a week and they get to advertise their flowers. You get fresh plants and flowers and they get free advertising. As you're walking around, look up as well. Your clients will. Now, you and the team may know that the water damage was from 10 years ago. A new client, that could have been last week's huge thunderstorm. How much is a new ceiling tile or a can of white spray paint to fix that? And why are you not vacuuming out your vents? These are things that nobody notices because it just becomes the norm. You know, this is a food room. It's okay if that's 2 weeks worth of food. If that's 3 months, I guarantee your cost of professional services are going to be high. And you got product going out. I would stop that pet foods. That's a dental suite or another exam room, more revenue producing that has more profitability than that food has. So do the walkthrough, take your notes, come back to the desk. You're going to review your revenues. How are we doing year to date and last month, and comparing that to the prior period? Are we on track with what we expected? And you can add in looking at, oh, we just did that nutrition push. How are our nutrition or dental revenues coming? And look at those special areas. It's quick. Not spending a lot of time on this. And then moving to the 3 expenses. And I'm expecting, I hope you know what 3 we're looking at. Support staff. Are we consistent? How is the overtime use? Is it that 17 to 19% or whatever your normal is? 12 to 16, 21, 22% of revenue. If it's not, you're not diving into it. You just know to, in your calendar, schedule a time to look into it in greater detail. Professional staff. If you've been mentoring folks, are you seeing a change? Doctor production. Are they producing what you expect and consistently? If you see a doctor's production coming down, you've got an opportunity to meet with them. Maybe there's something happening personally that, it's impacting their production, and you have the opportunity to maybe salvage that doctor instead of them quitting and going somewhere else because of things that are happening. And I have had clients share that with me. And then looking at your drugs and medical supplies. Is it consistent as a percent of revenue? Now, in this one, it can vary because of delayed billing. So yes, if you order everything in March, but you're not paying for it until September, you're going to have higher revenues with a lower expense. So you might want to look at what's called a trailing 12-month profit and loss statement. In other words, 12 months ending that as recent as you can go. For example, a trailing 12-month June P&L would be from July 1, 2020 through June 30, 2021. And you can do your target ratios for the areas that you want to hit. You want to look at lab, you want to look at parasiticides, make sure they're on track with what you're expecting. Then you can look at your productivity. So doctor compensation divided by their production, new client data. Maybe because each month your receptionist is looking at that bonding rate, it's done the day before you do your 15 minutes. So her report's on your desk as a part of this 15-minute physical. And then building in your targeted areas where you're spending your time and effort in educating clients. Is that turning around and coming back? This is keeping your fingers on the pulse of the practice, looking at key statistics. As you do this more regularly, it's gonna take less time, which is good, because then you're more likely to do it. You develop greater sensitivity to the key variables. And then as you have more time, you can add additional variables into it. Keeping, not diving into the red flags you find. You want to set aside time later. I also like this, that you could meet with your key staff in other areas. Meet with your techs and they come up with a 15-minute or a 10-minute monthly check they do on their lab and tech world. And then that report is on your desk for your 15 minutes. Same with the reception, front area, customer services, client relationships. What should they be looking at? And then their summaries on the report becomes a part of your 15 minutes. The last check, as I said, clients can't judge your medicine, they judge the experience. So a part of this is keeping it fresh. And this is more a 5-year plan for freshening up something every year instead of waiting to the next remodel. Now, I've been in practices that they've got that burnt orange or avocado green formica, or if you took that painting off the wall and stepped back, can you tell there used to be a painting there? It's time to change. But a lot of folks won't do it because in their head, oh, we got to spend the big bucks. No, you don't. You can make each year just small changes. Year one, look at the landscaping. Make some change. Instead of planting petunias, plant marigolds or something else, different colors. You know, part of my background is in Forest Service 30 years ago. I hate cutting down trees and bushes, but it's something to think about. This practice was on a busy street and had those huge yews out front. And I said, I think we need to change that. You could hardly see the sign in the top picture because the yews were covering that up. They changed it. He had new clients coming in saying, how long have you been here? I've driven by this road for years. All he did was change the front. Now, you could change the color of the sign, new sign. I talked to a lot of folks that put in a new sign and right away they get new clients that had no clue there was a veterinary practice. We just tune it out as we're driving down the road. Same old, same old. Year two, go in the waiting room, change something, change the artwork, change the wall paint color. We're not spending a lot of money. You do the work. The team can buy the pizza and soda pop, and those that can on a Saturday afternoon come in and do the painting or put new borders across the top or something that just looks different. A new client education board or move it from one wall to the other wall. Does not have to be expensive. Year two, back to the outside. Maybe change the trim color of the front door and around the windows. Yeah, we're talking, you can set a budget of $1,000, not big dollars. Year four, change the exam rooms. If this always the cat room and that's always the doctor room or dog room, or this one's Dr. J's and this is Dr. S's, we can't switch them. Or change something in there, change the border and the ceiling, change the artwork. You know, take down this dogs of the world species chart and put something else up. It can be educational, or it could be just fun. Does not have to be expensive. Year five, have a team meeting, set a budget and say, what do we want to change? And let the team come up with something. The team can be involved in all of this and then start over. But if you're constantly showing things changing, then it subconsciously feeds into the clients that you're staying current. If you have parking lot stripes, one of my favorite, oh, I giggled and I lost the photo of this. I need to get back to that practice. They had blue stripes for handicap parking. And then after they resurfaced the parking lot, instead of blue stripes, it was blue paw prints. Oh, it was beautiful. Bright blue right on that new paved parking lot. Just delightful. So you can be creative with some of this. So bringing things to a close. Veterinary medicine is a fixed cost business. The more you can do with the same assets, the more profitable you will be. The more medicine you can practice. You're good at it. You need to work smarter, not harder, right? And I know that's easier said than done. I get that. I struggle with that personally. But trying to pay attention to using your team as effectively as possible, to practice as much quality medicine as possible is in the practice's best interest and the pet, and thereby your clients. So when it comes to the management side, fix the fixed expenses. A lot of those you can't change. Can't change your insurances necessarily. You can shop your merchant account fees, and I think you should shop that once a year. You can try to negotiate new electric fees, but over the years, I've only had one client actually be able to do that. Once you're managing your inventory, your variable expenses, and you got that set, then it focuses on the revenues because it's the easiest to impact. Capturing the missed charges, minimizing the discounts, practicing more medicine. Because ultimately the goal is to move you from being average up to that financially healthy practice. Because less than 1/3 of all practices is financially healthy. So all of this, I think diagnostically, for every practice, it starts just like a pet, right? Starts with the initial appointment. I'm a fan of every practice being valued every 3 to 5 years. We take your practice on a veterinary practice appraiser's exam table. Now, every 3 to 5 years on an ongoing basis, that's normal. However, if you've got exit planning or estate planning or planning a remodel, expansion, relocation, any of those, yeah, then doing it sooner is probably better so we can look at that cash flow and make sure it's good. When it comes to having a valuation done, it's important to mention to the appraiser, it's being done. I'm not selling. This is for management and diagnostic purposes, because you don't want just the number, you want the insights to go with that. When you select an appraiser, I think you need to look for three things, three key in that appraiser. Certainly you want an objective appraiser. That's not one of the keys, because you don't want an advocate. High value for the owner and low value for the buyer. That's not giving you any benefit. You want an appraiser who understands valuation methodology, and that you can see by a credential. I'm a CVA, Certified Valuation Analyst. There's also CBA, Certified Business Appraiser. Those are the two main credentials. Then they understand the methodology. And as I said in the beginning, I have another YouTube video on the Simmons channel that talks about practice value and valuation. They should be veterinary specific. They need to understand the profession. We make adjustments to the income statement, and that's key. You can inflate or deflate a value if you make errors in that. And because the goal is fair market value, they should understand the market. So one source for appraisers is the Vet Partners Valuation Council. I'm a member of that. I've got 24, 25 colleagues, friends, and competitors on that council, all veterinary specific, all credentialed. Names you recognize: Gary Glassman, Denise Tumblin, Karen Felstead, Leslie Mamelis, Michael Hargrove. They're all the speakers and the writers in the profession. And we meet every month to talk about valuation. It's great stuff, and to really chew on it. Vet Partners is the Consultants Association, and there's veterinary architects, veterinary attorneys, financial planners, practice management consultants, HR specialists, etc. So it's a good resource for advisors. The Valuation Council also put out the Valuation Essentials publication. I believe it's on our website, vetpartners.org. I have it, and I can email it to you. Just send me a note and I'll get that to you. It covers more information on practice value and the valuation process. It's great for owners and future owners alike as foundational information. It's not going to teach you how to value, but it'll teach you, our goal is to help you become an educated consumer of doing it. The typical valuation usually is going to be somewhere around $3,500 to $5,500. But you want to make sure that being done for management and planning purposes, so you get as much information out of that as possible. So my contact information is here. I hope you got something out of this that made it worth the time this evening on a Thursday night, sitting for 2 hours. Like I said, if you send me an email, I'll turn these slides into a PDF and I'll get that to you with some additional reading material. If you have questions, we'll sit around and address those. Otherwise, thank you very much. I hope it was worth your time. and we'll see you at the next one.
Thank you. Good night.